And hi, everybody, welcome to another edition of Your Money Radio. Danny Stewart, Don Vanderboord, in 3 different time zones. Danny is in the mountain. Danny, where are you? Crested Butte?
Crested Butte, Colorado.
Crested Butte. Danny is in Crested Butte. He is, where's Crested Butte at? No one knows where that is. Well,
right
I should
outside
say.
Right outside of Gunnison. It's southwest Colorado.
Southwest Colorado.
Up in the high country.
What's the temperature there right now?
Oh, it's beautiful. It's about 70, maybe. It'll get up to about 80, maybe.
It's 104 here in the Metroplex, and I am not thrilled about that. Don, how are you?
Great, Tim. How are you?
What are you sporting today? What is
Kiss, of course. Just Kiss.
Just Kiss?
Oh, yeah, and before you start, I got this for Don. I saw this in a little shop.
Dan, that's beautiful.
It's a kiss button.
Now I don't have to ask for a raise. Just send me that button and I'll be all happy.
Yeah, that's what I was thinking. and I went by to get a Camp for Coffee mug for Tim, and I missed it. I didn't realize they closed at 6. I thought they closed at 7. So
there should be
a swing by today.
There should be a Camp for Coffee everywhere. Like, you should be able to send your adult kids off to coffee camp. I would go to that every day.
You didn't get a Taylor Swift button for Tim?
Good find one.
Shake it off, Don. Shake it off.
Don, speaking of coffee, they're actually opening up a coffee shop in Fort Worth where they've got a glass wall, and behind there you can watch them roast and grind the coffee, Tim. And they have little camps where about 5 to 6 people can go, and depending on how much you pay, you get to roast a certain amount of coffee. You get to keep it, and they.
Oh my God, that's so exciting!
I know.
I'm all down for that.
Yeah, he is.
Like, I'm totally down for that. So here's what we got going on, stock nerds. It's the morning, so look, this is a big deal. So we never shoot the show this early. This is about a half hour after the open, and we thought it'd be a good idea to shoot the show since Danny's going whitewater rafting. And wait, are you going whitewater rafting, or did you go whitewater rafting?
This afternoon at 1 Mountain Time.
So here's the thing: we're a life preserver. I was going to make the joke that we don't know if we're ever going to see Danny again, but I thought, don't tempt fate like that. So Danny, wear a life preserver and do they wear helmets for that?
You can, yeah. My definitely the girls are going to wear helmets, but I
wear a helmet too. Yeah,
you got your arm floaty things.
Oh yeah, get your wings on, man. Get your wings. Look, so what we're going to do is I got a question on Twitter this week about UPS and having it be a quote unquote opportunity, and I responded super nicely, like how we, hey, I'll show you how we screen for stocks, but I'm not looking for, I don't give recommendations or opportunities. I show you our process, and then it's to the individual investor to which we're empowering to make a decision. And I want to show that process this morning because a lot of you screen for stocks, and a lot of you will brag to us. And I used to get this a ton when I was at IBD. I look at 3,500 stocks every weekend, and I used to say, great. How do you eliminate 3,500 stocks? Like, how do you get down to your top 10 or your top 5 or even your 1? Like, if you had one trade to make this coming week, if it presented itself, what is it that you're looking for? And so a lot of people can't answer that question. And that really is the secret to what we're doing here at Revere. It's, let me explain this real quick. It's a 70% fundamental and 30% technical approach. And so what you want to be able to do is screen. I haven't screened this morning purposely because I want to show you. And I want to show you one of our tools. It's a free tool. I've got screens that I've designed in-house. Don's got his own screens. Danny looks out the window through a screen. It all works. See how I did that, Danny? See how I did that?
I like that. I like that.
Yeah. And so what I just want to, I don't want to inundate you. I'll show you the screen. You can build it yourself. But what you need to be able to do is eliminate. Now, nothing might turn up today. So there's always that possibility, but I saved that for you. I want to talk too about reasonable rate of return. We didn't get to this last week. It's a really great question that came in on Twitter. What can I expect as a reasonable rate of return? And that's a topic that typically sets Don off. I want to talk about Apple and Tesla splits today. Why we sold the Dow and the Russell at 3 ATR. I want to get into that. I want to do AAII and mutual fund. We've got people in our world that have been mutual funded to death. And enough people have come to us that have been mutual funded to death this year that we know it's a problem out in society. It's a societal issue, Danny, being mutual funded to death. And so what I want to do is cover that a little bit and how you can protect yourself. And the stock nerds and market lovers that watch the show regularly, I don't think it's you. I think it's your parents and your loved ones that this is happening to, because you're their go-to person. So we want to be able to explain it to you so you can then, if not just show them this show, explain it to them. But before I start, Don, I've got big news.
Oh boy.
Really tremendously large big news. So I keep so you talk about the car. Hold on a second. I got to get the stocks up. I'm a little I'm going through a withdrawal, Danny, when I can't
Well,
see. So I've got all those cards, right, that you keep lamenting about, like, what the hell are you going to do with all those cards?
I'm not lamenting. I think that's your wife that's lamenting.
Yeah. Okay, I have no news on that front.
Before I even ask, right?
But I have no news on that front. But the typically the boxes of cards, that I order, they just sit out, and it's never been an issue. Like, here is a pack of 1990 Fleer, and it's the wax pack that you can easily get into. So I hear, like, the gate downstairs sometimes gets left open because I forget to shut it, and so I hear, like, zoom up the stairs, and then the footprint, like the footsteps of a maybe 3-year-old toddler. And so I'm like, I look up, I go, Remy? And then I hear zoom, 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 zoom back and forth with these little feet. And I'm like, what the hell is that kid doing upstairs? So I run upstairs to go see what the kiddo's doing. And then he runs, he shuts his bedroom door, and he goes, you go away now.
Nice.
Yeah. He said it
building his independent streak.
Yes, he is. And so I go in there and I see wrappers of these. And I'm like, Remy, what did you do? Like, he's never gotten into the cards. Like, it's not even a temptation for him. Well, this was the temptation yesterday. It was. This was the temptation day for him. So, like, Remy, what did you do? And he hides his face, like I can't see him. And I'm like, I see you standing there. You're just doing this. Like try harder. And so that's right, folks. I told my kid to try harder. This is not trying harder. Like, I will go with you if you, like, maybe dove under the bed or put yourself under the covers. He literally froze in place and just did this. And I'm thinking, try harder. So
if I can't see him, he can't see me.
Yeah, that's exactly the theory. So then I like, well, let's see the cards that you pulled, and look at what the little kid pulled.
A Shaq and an MJ.
No, that's a Jordan and a Jordan.
Yeah, both MJ.
Both MJ.
Yeah,
nice.
Well, this one, the sticker looks off center, but he pulled an MJ. I'm like, Remy, you got the good luck, buddy. So, and now they got to grade out. These are right. And now if they're ungraded and they're just or raw, they're like a $5 card. But if you can, this one's, well, that's May 21st. Let's find something closer. That's when the market was.
So that card can be anywhere from $5 to $1,380.
Yeah, it depends on. Let's get time recently ended. How about just recently ended? So graded recently. So this is probably more. This is August. That's that's not PSA. So here is a PSA 9 mint, $77. The difference between 9s and 10s is huge. Oh, here's a 10 that just sold yesterday. So $170. So that just goes to show you, one, the spreads are wide in this market, Don, and it's all about timing. Do
you have to worry about the integrity of the graders the way, you had like the Russian judges, the Eastern Bloc back in the Olympics, and I'm a LeBron guy. I'm not a Jordan guy, so I'm going to rate this a 9 instead of a 10.
No, but I think there is. That's a real valid point you make, because there's only so much. Like, they're worth more if there's less PSA 10. So you go on to PSA, and our friend Mark knows all about this. He's the one who educated me to this stuff. Our mutual friend Mark from Buffalo, who likes the Josh Allen. And so, and I'm reckoning he likes the Buffalo Blue Jays because they got kicked out of Toronto for this year's baseball season. So let's see if he adopted those teams.
I'll take Jaguars defensive end Josh Allen over Bills quarterback Josh Allen.
Well, that's a debate. Who's the better Josh Allen?
Yeah.
Yeah. So Danny's just like, I don't even know who that is. That's all right, Danny. You don't have
Danny's
to know.
like, Dak Prescott.
I'll take Dak Prescott for 200, Alex.
Zeke Elliott.
What is suck? Dak Prescott.
Oh, that's harsh.
Well,
Even I, a Cowboy hater, know that's harsh.
Yeah, I gave it in the form of a question, so it counted. Well, that's right, Don. It is. There is no question. It's a declarative statement. Screw Jeopardy rules. So they only want I think, after doing a lot of reading, they only want so many of a population to be at a 10.
I see.
And so, but now there's already a scarcity in regards to like these types of cards because a lot of them just got lost or destroyed. Like they weren't worth anything. And so, like you could pick up the case of 1986 Fleer basketball that just sold for $1 million. You could pick those cases up for $5, all like through the late 80s, early 90s. Like nobody wanted them. Like so it's ridiculously crazy what the market is. But anyway, it's a wide.
So that's a good thing about the market. We don't have to argue about the analyst judging of the price. We can see what it's actually trading at on the screen.
Real quick. Let me see something here.
Nice segue, Don.
Was that a segue?
It was a very good segue. That was a very good segue.
Did my camera just disappear? I think I hit a button.
No,
can you guys
see you?
I can see you fine.
All good.
Okay, because my screen. Let me. Do you guys? What do you see here? Do you see my?
I see the VIX.
Okay, perfect. That's what I want you to see. So I've got this up here. So I'm looking here at Tesla, and I wanted to. Don just said analyst, and it gave me a thought. So Tesla up 1% today. So who was the analyst? Bank of America, or was it Morgan Stanley, Don? That
both 2 upgrades today.
Okay, so 2 upgrades today. Okay.
One upgraded the price to below where the price was, where the price is right now. And he's a guy, Jonas is his last name. He's the Jonas brother that is not in entertainment, I guess. But it is entertaining to see him tap dance about how bad Tesla is. And finally equal weight, just to equal weight now from underweight.
Yeah. Analysts are tough. And so that's why when people ask us about upgrades and downgrades, I will, and it's not really much of a joke. When you get an upgrade, I mean, can you imagine now there's supposed to be a wall between the traders and the analysts. I give you the Jordan shoulder shrug like that. You know what I mean? Like, is there really a, and so the downgrades that you get are typically,
it's more of a border. We need a wall, but there's more of a, it's more of a border.
So they downgrade the stock.
Not touching that one, huh?
No, not even going. I'm not even. No, you sank the show last week. I can't let you. I gotta plow
sank.
Forward,
I saw
man.
you say we had all-time high ratings.
We did have all-time.
Okay, well, that would be the opposite of sink then, wouldn't it?
Let me address that. So we've got more people because that's an interesting point you make. So we've got more people watching what we do for longer than we ever have in the history of the show, which is like last month I ran a report for the month of July. It was like 1,040. It was the equivalent of like 45 days cumulative of watched content. Like we're growing and we don't even advertise, and it's astounding too because it's August and it's July and August where the markets are typically quiet, and of course we all know pandemic. And but the thing is, even though it's like pandemic and people are home and you can say that, there's more people lamenting on equities than there's ever been in the history of this because of the democratization of information. The internet makes it possible. And so we're competing in a much more crowded space, but yet our voice is being lifted by what we do. And so that's extremely interesting to me. So anyway, analysts, you don't need them in a bull market, and you sure as hell don't want them in a down market. So Well, that's the truth, right? Because people are like, who's buying something based on an analyst upgrade? You're either in it and you're benefiting from it, but you're not going to go, oh, Joe Jonas, he upgraded Tesla. Now I'm getting into it. And so, and let me show you folks something about Tesla. So I bought Tesla pretty aggressively this week. And so how we operate is, if you come into the shop, we don't just buy you willy-nilly. Like, pretend you're a new client and you came into the shop and joined the family. We're not going to buy you Tesla up here. And you're like, well, why? It's Tesla. You got to buy Tesla. Don't you guys own Tesla? Yeah, we do, but that's not a strategic entry. A strategic entry would be maybe you buy half a position off the 8, or you potentially wait for the 21. I bought Tesla for the entire shop off the 21. And then I bought it again this week as it on Wednesday. I bought it Wednesday as it came above the 21. 8. Look at this technical. So Tesla's in the top 5, top 10% fundamentally. It meets the criteria I'm going to show you here in a minute. And then I'm looking and I see the 5 coming through the 8, coming through the 21. I'm like, that's my setup right there. And so, and then away you go. It doesn't always work like that.
Aided by a 5-for-1 split. That didn't hurt Tuesday night.
Jesus, thank you so much. Absolutely right. So aided by a 5-for-1 split. And you could still add to Tesla. It was like 1480 when I was adding to Tesla, and it was already up. And so that's the thing I want to, it was already up and I'm adding to Tesla. And so when people say you can't add to something because it's up X amount of dollars, your setup's your setup. Now you can be patient and wait, but when you get your setup, you take it, and then, but your weaponry is a few things here, and I'll just list them. Your weaponry is, we're going to get to the screen here. Your weaponry is, one, it's your process, right? So we'll just put process, or pro for process. And that means 70% fundamental, 30% technical. Your second is size. And then your third is rules, meaning what gets you out, what gets you in. I literally couldn't spell rules, Danny. I know you're going to laugh at that. How to stop, pause, go. Is there an E? There's an E there. And so, so what's your process for identifying it? Well, it's just Tesla. Yeah, but there's other stocks out there other than Tesla that are doing really well that you probably have missed out on. And Don highlights them every week or every other week of the 21 over 21 list. I don't do such a good job of doing that. And so, meaning that I just show you what I'm in, but Don's going, okay, this is, he's giving you the playbook every other week with that 21 over 21 list. And if you want the playbook, you can email Don directly and interact with Don. And you know what, the easiest way to do that, let me show him before I start showing him the screening. The easiest way to interact with us is this. So come to contact, I'll give you 3 ways here. You can come to, there's Don's email address, there's my email address, America's Fiduciary right here, who is, you know what, Danny, one by one, we're going to dismantle the insurance industry from telling people that it's an investment. Insurance is an investment. It's not an investment, folks. And the sooner you understand that, the sooner you'll realize that people telling you that are just trying to huckster you for more money. You know, if you've got, is your car insurance an investment? Well, I'm insuring against my investment in a car. No, other than classics, no one thinks cars are investments. They're depreciating assets for 99% of Americans. Am I right?
True.
You're right.
Yeah. And so
that drive home of a new car off the lot is the most expensive drive you will ever take in your life.
Your life insurance, there are more efficient and effective ways to achieve your financial goals than insurance. And if you think about it like that, let's just phrase it. Is insurance how I'm going to get ahead in life? Said no one ever. Nobody has ever said, you know what, I'm gonna be Scrooge McDuck diving off the springboard into the pot of gold because I have insurance. Insurance only pays you if you die.
But it's whole life insurance, Tim.
Yeah,
it's whole.
Don, it's not bring you back to life. It's not cryogenically frozen like Ted Williams insurance.
It's whole.
It's not like Walt Disney, his head somewhere. And so, too soon?
Whole.
Like, it's insurance. Something awful has to happen for you to cash in. Well, I can take loans against it, and then it's tax deductible. It's oftentimes in your retirement. Insurance is not an investment. And those annuities, man, annuities are finding out, man, annuities are just awful, man. It's like waking up on prom and you got a face full of pimples. That's what annuities are. And I had a bunch of other analogies floating through my head, Danny. All of them involve swear words, and I didn't go with them. And the other ones were just
Thank
gross.
you, Tim.
Yep. And so the only thing I toned it down for prom night and pimples. But man, you put something heinous in there. You know what annuities are like? It's like, you know what? I'm going to eat that street burrito and then getting diarrhea. That's what annuities are. They're just awful. Annuities.
The analogies are spot on this morning.
Thank you. Gas station sushi are what annuities are, folks. You wouldn't do it.
Gas station sushi. Yeah.
Yeah, you know, I'm going to pull up into the mobile Exxon and I'm going to get myself some sushi. Get myself a spring roll.
All kind of downside alerts firing this morning.
Oh, that's interesting because it's Friday. Let's look at this. So,
not reflected in the indexes as much as some individual leaders, which have gotten back above the 21, falling back below the 21 on a Friday. And you want to see what they do on a Friday.
Yeah, here's what I think is going to happen. Your people are fearful that you're going to get a repeat of last Friday, where last Friday started the start of a 3-day pullback in leadership stocks, which Don is just alluding to. But the indices aren't falling apart. I think you're going to see it's 9:30 right now. And then for those of you that don't know, 9:30 Central in the markets is the start typically of like it feels like a new market phase. And then 10:30 Central is European close. And so you'll see the NASDAQ here extending. I think you're going to see this kind of jostling. And it's not measured. The ticks are still positive. So you're just seeing it in the NASDAQ. I think you're going to see whipsaw action until 10:30, and then it's anybody's ball game. But they'll run them up, and then let's take a look here. So Zoom comes off about 4 or 5 points. Let's see, Roku off a few, Apple's coming off a little bit. We'll see what happens here. Amazon doing Amazon things on Amazon typically pulls back on a Friday. That's interesting to me. And then next week is options expiration. So all that factors in. Anyway, where were we?
You were talking about Tesla. And by the way, I got my confirmation. I looked out the window through my screen and I got a confirmation Tesla was a buy.
Is that your screening process? Let's do that.
That's my screening process, yeah.
You've been sitting on that joke for at least 12 minutes, Dan. You could not wait to get that out.
I was gonna say it earlier that Tim took a left turn again and went off on insurance. And so
that's what I was doing. I was showing people how to get a hold of us. Look, the easiest thing to do is call us. We're never going to spam you. 855-732-5932. But the easier thing to do is follow us on Twitter. Like here's my Twitter handle at TJ Razor. You got to let me know you followed us though. Like if you follow us, you can then shoot us messages. I have to follow you back. So does Danny. Here's Danny. Oh, Danny, where are you at right here?
That is called the Secret Stash. It's a real eclectic pizza. It's one of the best pizzas in the world. But
really?
Yeah, and the lady that founded it, she's traveled over 50, 60 countries, and she's brought all this Eastern, art and all kinds of weird eclectic stuff. And so the inside is just very neat.
Okay. And then here's Don's, and we're going to get to this. Here's Don's Twitter handle. Let me show Don's handle. Why can't I see Don's handle? It's at 1D Vandenborg, but I highlighted this.
No one.
Oh, it's D
Vandenborg.
Oh, there it is. No, that's not your handle.
No, that doesn't show it.
That's weird.
Yeah.
There it is. There it is, D Vandenborg. And I'm going to come back to this getting mutual funded to death here in a few moments. But let's talk screening, folks.
And I thought you were going to show what I retweeted last night, the street fight of the guy with no legs versus the guy with legs. That was a pretty good.
No, we weren't going to show that.
No, you weren't going to show that one? All right.
No, I wasn't going to show that, Don. But your attempts to foil me are lost. And so let me do this. Let me come in and log. I'm logged in already, I believe. Yes, so I'm logged in. So this is a free tool. Let's go screener. This has all kinds of pop-ups, so I don't know if we'll get all kinds of pop-ups. My presets. So I'm going to do gross screen. I got gross screen high short interest or with 300,000 minimum for volume. And so there's a couple things I want to highlight here. One, you can pause the video and you can get this gross screen. You can just copy it. We'll give it to you. It doesn't matter. What I want to point out to you though is this. It's 8 names. And so a lot of you, now this is just one screen, but a lot of you are going to try to make your screen so robust that you come up with 500, 1,000 names. Look, there's a bunch of you that can go through 500 stocks and you're just pattern recognizing. That's all you're doing. That's fine. But to make decisions on stocks, you got to start eliminating them. And the secret is eliminating the ones that don't have the highest propensity to move higher in price. That doesn't mean they're going to move higher in price. It just means that they've got the moxie, the propensity to do so. And that's a certain subset of fundamentals and a certain subset of technicals. And so like I could just hover over one of these names and you'll see this chart. Well, there's Amazon, that's a daily chart. There's Dexcom, that's a daily chart. And notice, and we'll pull these up on the bigger charts, but notice as I'm rolling through, these all have a look to them. Look at PayPal, look at TTD, and as I should probably scroll the screen up. Let me see if you guys can pick up on this. And I'm doing this live with you. So what I'm highlighting, oh, it won't let me do it. So if you look to the chart, just look at the consolidations towards the right-hand side of the chart. They all have some kind of, they all look a little similar in this regard. And I find that fascinating. Like I haven't done this morning. And so, and you're like, well, did you do it last night? No, I didn't. I usually do all my screening on a Sunday. And so they all look the same. And if we pull up the list here, like Amazon. And so Amazon on the daily chart, yeah, this is a great looking daily consolidation. So you've got 8 and 5, you've got the 21 here. And so Amazon went from being up to being down on the day, but it's just consolidating. It's had this tremendously big move. And so what you, as it's digesting that, is it going to continue? What a lot of, that's a beautiful 4-hour chart too. What a lot of people don't realize is this, is that when you, that the movement of leading stocks, of the ones that have the highest propensity to move higher, they typically go up anywhere from say 15 to 20%. And then they rest and they base. And a lot of people want to catch, and I'm just highlighting this latest advance, they want to catch this. And that's great. And there might have been this might have come from a prior consolidation. I've owned Amazon this year since March 31st, maybe March 23rd, something like that. But what I'm showing you here is that it has to rest after these advances. And so is Amazon broken? Is the market broken? No, this is a stock that's had this great advance. And so what happens now that you screened for it fundamentally and it showed up technically, and I know it's so easy because it's Amazon, right? You're like, well, it's Amazon, of course you buy Amazon. It doesn't, what about Dexcom? We're gonna do Dexcom here in a moment. But look, it's just working this sine wave. And eventually, if the market's still intact and the story of the stock is still intact, supply and demand becomes an issue, meaning that the people that are buying at the top of the range, or they're buying at the, they're buying in this range here, and eventually they want enough of it that there's not enough supply, and then the stock pops. And that's a real simplistic way to put it. But if we look at like Dexcom, which is on the list, here's Dexcom. They have a similar pattern. I believe PayPal was on the list. Similar pattern. Like here's the advance. There's your advance, and now you're in this consolidation. What else was on that list? Vive and TTD were on that list. So we'll look at Vive, TTD. And so it's not that you're screening for a bunch of like 1,000 stocks. You can look through stocks and do all your pattern recognition that you want. I'm not saying you shouldn't do that. I'm saying that you need to be able to eliminate which stocks, because owning 500 1% positions, just buy the index. And at that point, and we see, Danny, we see people like that come into the shop all the time.
Yeah.
They got a, yep.
17 mutual funds for diversification.
Yeah, and it's just ridiculous. Don,
All owning the same stocks.
you want to talk about screening, Don, or any kind of stocks? I'm
Well,
going to go on the
I
short
want
screen,
I
too.
want to point out that it's something I mentioned last week. I heard one of the IBD portfolio managers mention, William O'Neill would say it's not the chart that makes the stock double. It's what you have highlighted there, what you're screening for, the fundamental story. Your chart can look great if you've got zero sales growth and you're in a declining environment. What's going to make that stock double? No, you've got the fundamentals, you've got sales growth, you've got earnings growth, you've got a new product or a new service. That's what brings these stocks up on your screen. And then you just look for the formation and the proper entry point.
And let me
But it's the fundamentals that makes it go higher, not the chart pattern.
And let me just really stress this word here, because before, it doesn't look like, I know it's not 2 words. It looks like I spelled before as 2 words. I did not. I swear to God to you, I did not.
That looks like 13EFURE.
Have you seen me draw a car?
I love your antelopes too. Your gazelles are amazing.
And so, like the question came over the transom as UPS. And so, like, earnings are such a binary event. You don't know that it's going to do this. And I want to really dive into this for just 1 second, folks. You might think that UPS is the greatest thing, right? And like everyone's got the pandemic packages coming. Here is May. UPS had earnings and it went down. And what you want to be able to do is screen for these ideas before they make that UPS move higher. UPS wasn't showing up on any of my screens. It might now. UPS might have turned the corner. And what you haven't missed a thing here, folks. As UPS works on a consolidation, its fundamentals, using the words may be improving. And so it's going to show up on your screen. But so many of you see the move that just happened in UPS, and you feel the, I don't want to put words in anyone's mouth, but there's a really good chance that you feel the FOMO. And then all you can do is focus in on this one stock when there were 8 stocks on that list that all look buyable. And by the way, this show is for your edification purposes only, never ever be misconstrued as advice. But I own Dexcom already. I've owned Dexcom for a while because it started showing up on my screens. And then it matched my rules for entry. I added a Dexcom this week for a few folks that came into the shop that didn't have it already off of what I'm showing you. And so what you want to be able to do is identify these stocks before they make their price moves. And it's easier, like, oh, UPS, that's what I want to get into. Well, now you're in this consolidation phase. And so, well, isn't it going to turn? I don't know. And the reason why is it comes down to, and I'm just going to just stop it at consistency. The stocks that Don and I and Danny and I endeavor into all have a makeup to them, meaning they're they've got these strong fundamentals, they match our technical setups, and then when they don't act right, we know to cut them. And act right is its own set of sub rules. And when they do act well, we know that they're typically going to go up 15 to 20%. And what's the old O'Neill rule, Don? If it goes up 20% in 3 or less weeks, you keep it for 8 because you got yourself this huge potential winner on your hands. And it's really hard to do that. And that's a hard-earned lesson from a mentor of mine named Bill O'Neill, because he lost out on some big winners because he sold them too soon. And so,
can I make one point real quick also? So on UPS right there, where it gapped up, if it had missed earnings, it would have done just the inverse. It would have dropped big.
right.
Now, if you had used Don's gap rules, okay, and you could have, after it popped, and you look at that first bar after the pop, and then you can use Don's gap rules to figure out whether it's going to keep going or whether it's going to gap and crap. You even though you're buying it higher right after earnings, it's a much less risky proposition,
right?
Because now you've got some kind of rules instead of just hoping they beat earnings.
And that's a big deal, what Danny's saying there. Like, we don't buy stocks betting on earnings. So, like, I don't know how many people because I don't listen to them or read them or fill my noggin with them. there's so many people that have theories on stocks. That's not what we do. Like, you never hear me argue for a stock. Like, I'm almost certain that there was somebody down here arguing for UPS. Like, it's UPS, they've got all these packages, they're delivering packages, and then it just, you know, and then you get a bunch of long-term investors in the stock, and if you bought options, you're hosed. And so, no, I want to identify these stocks before they make their biggest price moves, and when they break down, I want to sell them. And so,
by the way, another way to play those earnings, sometimes we buy stocks if they look good on the chart a couple weeks before earnings,
yep,
anticipating a run up into earnings, and then right before earnings, depending on how big of a gain we have, if we have enough buffer, we can hold it through earnings. If we don't, we sell it before earnings because we don't speculate.
yeah, and so but understanding your screen, I want to take this one step further. When I'm looking now, let's do high short interest and see if it changes any of the names. So here's growth screen with high short, none. So I got none. So no stocks with high short interest growth. But when I come back to my growth screen here, I've got the 8 names. And if you look at like what I got, TTD, EPAM. Let's look at EPAM in Dexcom, EPAM. And these are all in leading subgroups too. So here's EPAM. That's a nice looking chart. And then here is Dexcom, which we already own in the shop. I like Dexcom, trip to the 50, support back above the 8 and the 21. Yeah, I want to own something like that. So our process ago, I got more long the market, and it's because the put call ratio for this market was going higher and the VIX futures were going lower, and that's actually a bullish sign. And then Don, this is a screen capture off of Don's computer that he shared with us, and we talked about it last week, but he sent picture form, and pictures work better than words for most people. They do for me. And so this is the AAII study that we talked about. And so this is the current week. And so before I even get into it, I just want you to see the historical averages. So historical average, historical average, historical average. So most people spend their time historically bullish in the markets. And I want you to understand that. We're an optimistic people. And I don't think optimism is your friend in the stock market, even though I'm bullish, right? Don and I are constantly always looking for the signs of, do we need to protect wealth? Do we need to protect wealth? Like that, by the way, when you come on board with us, or you inquire about coming on board with us, I can't begin to tell you how many people start with, well, how much can we make? No. You might think that's a great question. You need to ask anybody that you endeavor in with, how do you protect the money I already have? Then how do you grow it? Because if you don't have it to grow, you're screwed. And we've spent a number of shows talking about that. So back to the chart. So when I'm looking here, historical average, bearishness is typically at 30.5, even though it was down 5.5 from last week. Look at based on the historical average, how many people are still bearish? And then look at the bullishness. It's 8 percentage points, even though it's up for the week. It's up for the week. It's historically below. And so that tells me that there's a lot of money on the sidelines. You're like, well, Tim, this is just American Association of Individual Investors. What do they matter? I've used this before, and there's going to come a point where it doesn't work as a contrary indicator. It's just one piece of information that really does make a difference in my world. And then I pair it with, okay, well, this is going up for, even though it's not up here where I really want it. It is going up, and for this market right now, that's kind of good enough. And the indices look fine, and I take that and I go, what are the VIX futures telling me? And it's like, okay, we held it. Then you go to like the leading chart in this market is the NASDAQ chart. And so you go to the NASDAQ futures, and you're like, okay, we come down to the 21 and we hold. We test it twice, we hold, and then we're going. And in our world, a test of the 21 is a low entry point, and this market hasn't closed below the 21. It's going to one day. Listen, it's going to, and the market's just going to get this is all going to end very badly one day. Like that's what we always joke about that on the call. Like, and we got to be ready for that. But until that happens, if you're watching whatever your news source is and you're bogged down in some real horrible things that are happening to people in this economy, you're going to miss the opportunity in the markets. And it doesn't mean we don't have empathy and respect and care and love for all the people that don't have jobs or that are struggling in this economy. It just means that we have an obligation to protect people's wealth and grow people's wealth, sans our emotions. And what I just described to you was a very emotional bliss process. Who wants to go first, Danny or Don?
Go ahead, Don.
Can you bring up the futures, or I'm sorry, the VIX again?
VIX futures, yeah.
Yeah, you mentioned something, but I want to just dive into it a little bit deeper. You mentioned we're always looking for an inversion, and then you said that the next closest out contract, so 23.25 is the cash, right? Is that the cash or is that the front month?
That's the current month.
That's the current month. So there's a couple of bring up the visual represent. Bring up VIXCentral.com.
Oh, sure. Let me see if I can. Wait, you want VIX Central and not eBay? Sure, I could do that. VIX Central. I don't. Have I been to which I spelled wrong? VIX Central. Here we go. What you got?
So this is just a visual representation of what you showed. The dotted green line is your people's VIX, the cash VIX, which is around 23, 22. Gotcha. And then the front month, you mentioned that they're going to converge because there's only a couple of days left. That convergence is not what we're concerned about, that, oh, the front month is almost at the cash, if that would invert. It's the next month, the September one, which is all the way up at 27. So the VIX has to go from 23 to 27, 20% before we would even get an inversion. So we're not even anywhere close to the VIX having to inverting, which would bring fear into the market.
And so, look, that's a lot of information, but what I want to point out to you, stock nerds, is that it's never just one piece of information. And you're looking for a preponderance of evidence to drive your decision making, because look, it's clarity comes from hindsight. And so it's real easy to say, oh yeah, you should have bought this and it's going higher and things are great, or you should have bought this thing. But no, it's having the courage of your convictions based on experience to take some action. And so that Don and I are constantly, and Danny, we're constantly doing this. Where is this? Where is this? Where is this going? Because that's what we get paid to do. And a lot of you are going, well, you don't know until it happens. And I tell you that every night. It's a market and anything can happen. But how do you do this consistently to remain in the game forever, to absolutely grow your wealth utilizing equities? It's risk control. It's a process. And it's understanding that you don't know the right-hand side of the chart, so you need rules to get you in and to get you out. All right, I'm going to tell you what, this is probably the best show we've ever done. I'm going to pause it right here for a second and just going to give myself a little golf clap.
Pat yourself on the back.
Yeah, you know what? I absolutely, yeah, God, that's a good, yeah, seriously, like, I think people charge for what we just did there. Like, I'm not being facetious. People charged for what we just outlined there and gave and did.
Look, but here's the thing. Look at that chart right there on the NASDAQ, and that pink line is what? Isn't that the 34? 21. Is that the 21? Okay. 20. If you look back, every time, sometimes it'll break through there, but usually the best entry point is when it pulls back to the 21. So if you're patient, because if you bought it at, you see that huge green bar kind of in the middle, a little to the left of the middle, a little to the left of the middle.
Give me a second here as my charts go haywire. What are you talking about, Danny? Green bar.
So yeah, go to the left, keep going, right there. So if you
Gotcha.
bought it at the top of those bars and all of a sudden it pulls back 8 or 9%, you're starting to get nervous. It makes you, you know, question yourself. And so
Right.
psychologically, it's not a low risk entry. When you're buying off the 21, it almost bounces off the 21 almost every time. And all of a sudden you give yourself a 4 or 5% buffer within in a week or 2 weeks or 3 weeks. And it makes it a lot easier to then hold through small pullbacks. It's probabilities.
And then Danny's looking at these bars right here. And one of the other tools that we use to help you with that, to help you visualize that we use, is right here. It's the third ATR. And so when you're extended, people are constantly telling you, the market's extended, the market's complacent. And if you really want to know if a market's extended, understand that hitting that second ATR, that especially the third ATR, you have increased dramatically your probabilities of a pullback. And it doesn't always have to pull back to the mean, but that's typically where you're going to get your best entries. And if it starts breaking below the mean and closing below the mean, then you know that maybe something else is afoot and you want to exit. But what happens is oftentimes folks will get over leveraged, like some of you, and we get it. You got 25% positions in Amazon. Well, when Amazon corrects 100 or 200 points, regardless of the percentage, and you got a 25% position in your account, and it hurts. And here Don and I are advocating every week, every night, 5%, 10%. Position sizing is your weapon. No one position can destroy you. And so, but that happens to so many people. And there's going to come a day where this NASDAQ does start closing below the 21, and it's going to be time to sell. But if you got incredibly long right up in here because you started feeling the excitement of the markets, I can't begin to tell you how that's just a wrong approach. You know, it's not methodical, that's emotional. And so I got to look at what silver's doing right now, but silver just did this to me where, and what do I mean by that? Like I wanted an entry in silver, but I'm like, gosh, it's all the way up here. And then you miss this big move and you feel like, oh man, I just missed that big move, but it wasn't my setup. And you're like, well, it pulled down to the third ATR. Like I just know that it set me up for a pullback to the mean. I just have to wait. And so it pulls back on this day here. And then I got silver on Wednesday. I bought silver and SSO on Wednesday. And so I get the futures, and I want to point this out to you. The futures pull back to the mean, and now they're starting to work, even though it's down 3% today. But SLV never got back here. Like you don't even get this low. And so, well, what's the point of me telling you this? That when the market has a futures market available to it, I take my signaling off of the futures market, and this hit the mean. I want to buy it. That's my setup. So I'm going to buy some silver. And so now, does it work its way back up here? I don't know. But I know that being patient, like you gave up 1, 2, 3, 4, 5, 6, 7, 8, maybe 8 to 10 days. It was just consolidating here, like 8 to 10 days of gains, and if you bought silver up here, your outlook, and it doesn't matter if it's silver, if it's Amazon, if it's Tesla, if you buy it up here and it corrects back this much, your outlook on things changes dramatically. You might think that, yeah.
You lost 10% in one day. And by the way, what I was saying was, now this is a little bit exaggerated, if you will. It doesn't usually happen of this magnitude this quick, but our entry point after the pullback, we were up like 10% the very next day. So yeah, we're down 3, but net we're up 7. It gives you a higher probability entry point to be able to buffer the moves.
And I'm like you, stock nerds. I want in. Like when you want a market, I'm a fan of saying if you want a market, you buy a market. And I wanted silver, and I had to just watch this. And I'm like, it's painful. Like I'm with you, man. It's painful. Like you're like, okay, 20 to 20, what to get up to 29, 30? Man, those are some really good gains. And of course, everyone always does you bought it right and you sold it right at the top, right? And so that was tough to watch, but it's everyone's fantasy. And so, but this allowed me, having this chart set is what allowed me to just go, okay, just wait. It's going to correct. It's going to correct. It's going to correct. And speaking of that, let me see if I can find that chart set real quick, Daniel. Oh, not sure what performance problem detected. Let's get that off of there. I think Thinkorswim is a performance problem detected. Let me see if I can get that off of there. Thinkorswim. If you don't, if those of you who don't have Thinkorswim, when I tell you that it is a tough slug some days, I don't know if I can get that off my charts. Oh, there it is. So it's off. So look, this is a weekly S&P chart. So let me see if I can, it wants to lock up on me right now, but that's okay. So this is November of 2019. Here's December. Look, here's the mean. The 21 purple weekly chart is the mean. And you can see that it tests the mean and then it bounces, but it comes back to the mean, crashes through it. Then you get these two closes above the mean. And so many of you think you missed the move. Like this is 3,000. This is below 3,000 here. Like I missed the move. It was down here at 2,200. I should have bought there. No, you can do it on a daily chart. You got two closes above the 21. But if you're like you're a little slower, you're a little more patient. Two closes above the 21 is here below 3,000, and now you're almost 400 points higher. A lot of money to be made in 400 S&P points and a bunch of stocks. So it doesn't matter what your approach is, whether you're using daily charts, weekly charts. Maybe for your entries you take them down to 4-hour and 78-minute charts like I do. But you're going to get your opportunity, and if you're not participating, which is where I was starting with all of this, you're going to come down to the weekly 21 eventually. I don't know. It might take to the presidential election. And that's not a political statement. That just means maybe we just stay buoyant until November 2nd. And if we do stay buoyant, you're going to want to participate in some stocks. And if we come down to the weekly 21 or the daily 21, like we were outlining, you have a rule base to actually take action on. Any comments, Don?
Where that's up in the upper left, where it says SPX20YW. The W is weekly. What is the SPX20? What does the 20 mean?
Oh, well, that's the it's a 20-year chart.
Oh, okay.
Yeah. So I can come, like I can show you now because I think my charts have unlocked.
Okay, so if you scrolled out, it would go weekly up to 20 years.
Yes.
But you're scrolled in, so it's showing you. Okay, gotcha. The last year.
My charts are my. I don't know if you noticed, Don, I had a performance issue detected by Thinkorswim. The good folks at Thinkorswim have detected a performance issue. So yeah, I don't know if I'm screwed for the rest of the show. We'll see. I've got other content. If I can't get I can get a chart here, so we're fine. Like if SPX, and then I take it to a weekly. Oh, this is a 15-year chart on this, and so yeah, and that's hard to see. So it's hard to project. So anyway, that's screening. God, that took a while to do screen, but screening is so important, and it melds itself into different sets of rules. Danny.
Look at that long-term chart right there, though. Every time, not every time, but many times, more often than not, when it hits that third ATR to the upside, you have a pullback.
Mm-hmm. Oh yeah, that's the big takeaway, that you're increasing your probabilities, and it's not an absolute. This is a weekly chart. So imagine how extended you are on a daily. And so, and if you're looking at the SPX, let's just get it back to a daily chart. There's room for the indices to run here. And for folks to say that here's the S&Ps, and you're like, well, Tim, that's really close to the third ATR. It is, but what you're seeing here is this consolidation. But what's been the leading indice? What is the one that has the leaders in it? And you could look at it two ways. You say, well, that's the one that's starting to break down. Maybe, or is this the pause that refreshes? And you'll never know. But you've got two ATRs to go here as you consolidate off that first ATR off of the daily mean. And so,
and even if you wanted to have some exposure into the markets, even in lieu of a total breakdown, once you find a good entry point once it goes up to the 38 ATR, you don't have to sell everything, but if you take just a third or half off the table, wait till it comes back to the mean, reestablish that position. And so a portion of your portfolio is going in and out when those technical things happen. And then you've got some for just exposure in the market until you've got something like a March of this year event or December of 2018 or the economic crisis of 2008 and 9. You don't have to get super defensive.
And I want to point out to you as well, like the markets are pulling back here. So there's a lot of information on this chart. One is this average true range. The average true range of the NASDAQ 100 indice, which is what I have up here, on a daily basis to over 21 days, is almost 200 points. You've traversed 40 points today. So, it depends on how you're weighted and what stocks you're in. Is the world coming to an end? I don't know. It depends. It depends on if you're trading options. It depends how heavy or weighted you are in certain equities. And that's why we're just the biggest advocates of the approach that we talk about, because it can give you that consistency. But patience, Dan, the patience to develop that it's lost in so many different places because it's not quick. It's not bad. When you see Tesla go up like 150 points in a day and you're not participating, that's what they talk about on TV or Twitter, and everybody's getting mega rich and you're like, I'm not. And then that's what leads to investing mistakes. So what's that old E-Trade commercial? You got money coming out the wazoo from the 2000s. They ran it during the Super Bowl, and turns out that was the top, So
I missed the E-Trade baby. Those were good commercials.
You like those?
Oh yeah.
I'll tell you the ones I really hate.
We need to train Nora to do that for some for some Revere commercials.
Yeah, I can't stand. They haven't run them in a while. The Schwab commercials where he's in a loft and you've got an idea and you just wake up and you're going to go to your screens and the inclination that you are going to wake up, go to your screens, turn them on, and you're just going to execute and make money.
It's the Epiphany Trade.
Yeah, and look, I get it. A lot of you are very talented traders, and you do turn on your screens and you analyze and you work through how the risk reward and probabilities to how can I have a positive outcome on this setup. A lot of you do that. But what Schwab is doing is selling a false prophecy to a bunch of people. And they actually stopped running that commercial when they went to zero commissions.
I didn't think about that, but you're right. I haven't seen it in a while.
Yeah.
And by the way, they all do it. It's all the same.
No, they all do. Yeah. They all do. Don, I want to talk. Don sent a real interesting, let's get to this actually, a real interesting note over the other day on Twitter, from Twitter. And it's about this. And then we've had, and I'll leave it generalized and anecdotally. Oh, I got the wrong screen up. I'm sorry. We've had a number of people this year come into the shop that they've just been mutual funded to high holy hell, and it's not right. And what happens is these advisors or these brokers are loading you up in mutual funds, and so they can blame the performance or lack thereof on the advisor, and so it's always deniable culpability. And that's what these advisors do. And so then they'll ask you, well, what do you want to do, Bob? And which is, I think, just, well, what the hell? What do you mean? What do I want to do? I'm paying you to figure this out for me. Why are you asking me what I want to do? And then Don alluded to it earlier. Then they blame you. Well, you told me you had some risk in there. And having a high risk tolerance doesn't mean that you like to take losses. Like, can we just say that out loud? And because that's what that's what sorry, Danny, it's a kid's show. That's what jerk advisors do. They say, well, you told me I had a high risk tolerance, and so I put you in these high risk funds, and now you're bitching to me. And well, just because you have a high risk tolerance doesn't mean you like to get kicked in the nuts every other month. And so It's a kid's show, Danny. The family jewels. And so high risk tolerance means that, okay, I can accept some volatility, but what are the rules? What are the parameters? Why are we holding something with 35% losses? And high risk tolerance doesn't mean you are okay taking losses. You're not. I mean, I shouldn't say taking losses. You should be okay taking losses, large losses. Can someone clean this up for me?
Well, here's the whole illusion around that risk tolerance thing. First of all, when people's risk tolerance changes with what the market's doing. When the market's going up, everybody wants in. When the market's going down, everybody turns into mush. They're a wimp, and so they all want to get defensive. So it's really not true. And by the way, a lot of times what these big brokerage wirehouses are doing when they have you fill out that questionnaire is they're actually psychologically profiling you. So if they know you're really, really nervous and scared all the time, they're going to put you in a bond fund next time you come in. If they know that you like to go to Vegas and you like kind of action and you like to play the sports cards or, gambling online or whatever, then they're going to give you an aggressive growth fund because you like the choppiness, you like the action. And you do, as long as it's going 3-4% one way or the other in a day. But once it sells off 15, 20, 30%, then everybody's bitching, as Tim would say.
Yeah, and then the problem is, well, it's already sold off 20%. We can't sell now as it sells off another 15%. And so, Don, can you discuss that for a second?
Tim, it's not a loss until you sell it.
Yeah.
Yes.
I say it all the time. We'd rather manage $60 million well than $1 billion poorly. When you're with these big firms, they simply can't do what we can do because you can't turn a $2 billion fund. You can't protect the downside because there's too much to sell. Everybody's just thrown into the pie, and your definition of protection is rebalancing from 65% stocks to 63% stocks.
Yep.
It's an index. So then you lose the strength of individual growth stocks, which is basically what our shop does: identify the strongest markets and then the strongest sectors and then the strongest stocks when the market is in our favor. But that quote that you brought up, since 2009, investors have collectively paid $1 billion more in fees to liquid alternative mutual funds than what they've gained in returns. Think about that. We say it all the time: diversification into a junky asset class is like buying rotten fruit at the grocery store just because you don't have any fruit at home. There's no reason to be in something that's going down. Just because it has a fancy name like liquid alternative mutual funds doesn't mean it's right for anybody. And it's designed to minimize, to protect the downside and to reduce the volatility of your portfolio. Well, what you got was $1 billion more in fees than you did in gains.
The only way, stock nerds, to protect your portfolio is one of two things: you sell or you hedge. Diversifying your risk, when the ship's sinking, a little piece of it doesn't typically stay above water. It all goes down. And March was a great example of that.
Well, that's a lie. That's a lie about diversification. Just when you need it, the correlations all grow together, and it all goes down together, albeit at different rates. It still goes down. So when you've got that, you either need cash and maybe treasury bonds and short selling ETF, and possibly even gold. Sometimes gold and treasuries will become positively correlated. There's only 1 or 2 or 3 asset classes you want when it's going down hard.
Yeah, and I'm telling you,
TLT fell 22% in 2 weeks in March because it was a liquidation event. Funds were over leveraged. The baby goes out with the bathwater, and what's considered safe drops 22% in 2 weeks.
And the adage that it'll come back. Look, it's a market. It doesn't have to come back. Like, there's a bunch of stocks, and we could list we could do a whole show on it. Stocks that don't come back. And if you're the one left holding the bag,
or countries that don't come back. Japan peaked in 1989.
Yeah.
Yeah, and the leading stocks of one cycle aren't necessarily the leading stocks of the next cycle. That's sometimes they are.
Yeah.
Amazon's been the leading stock in the last few cycles each time, but one of these days it won't be the leading stock of the next cycle.
Or it could still be a leading company, but it
Right.
sells, but it starts closing below its 21. And a lot of you are like, well, if it's still a leading company, I want to own it. And look, I understand that, but what you don't typically hear, what we're going to discuss, several times along Amazon's journey, it lost 97% of its value.
Well, remember Dell
That's
stock in
extreme.
the 90s. In the 90s, they called the people that own Dell stock Dellionaires because they
Yeah.
buy Dell and just hold it. And in the 90s, Cisco Systems was another. Dell finally in the early 2000s came under so much pressure. Michael Dell had to take it back private because they were worried about not making it. They had to really fundamentally change. And so they went public again, I don't know, 5 years, a while ago. But
Amazon can be a leading company for the next 50 years, but its stock's always not going to be something you want to be in. And that is so, it's just a different way of thinking for so many investors because, well, I'm going to hold it forever, right? If you held Microsoft, well, Microsoft was dead money for 15, 17 years.
Yep.
I mean, what did you lose opportunity-wise in 15 to 17 years? The dividend doesn't make up for that opportunity cost. Well, I was writing covered calls on it. That's always I was selling covered calls, so I was okay. No, you held on to dead money, and this happens a ton to individual investors. It happens to, by the way, it happens to professional investors. It happens to a bunch of people, meaning that something that made you money in the past, you want to hold on to because it's going to make you money in the future. And Microsoft had topped out in the early part of the 1999-2000 debacle, and then it never really came back.
Wasn't until they got management change at the top, and that's
some of you held Yahoo stock that long.
Oh, ouch!
But great example.
Yeah,
great
and
example.
So yeah, or even
Amazon
AOL.
Came back. Yeah, or AOL, WorldCom,
Yep.
Sears, GE.
Yep, you don't have to hold these things. If you sell it and you wrap up profit or you minimize your loss, if it shows you, the reason why you sell on the charts, not on the fundamentals or your gut growth, your gut feeling about its potential for growth, is because the fundamentals lag by a quarter. And so to know, like a lot of you will cynically say, somebody always knows. Like when you see a stock sell off or you see a stock shoot up higher in price, and then like a week later the news comes out, like somebody always knows. Institutional investors always know. Whether they know or not is irrelevant. The reason why they always know is because they control the markets. So if enough institutional investors, the mutual funds, the pension funds, the hedge funds, if enough of them come in and start selling the hell out of Amazon, Amazon could be making geese that lay golden eggs. It doesn't matter. If enough of them come in and start selling the hell out of Amazon, Amazon's going to go down in price. Well, like it'll come back. Does it? Will it? I don't know. And so the only place you see what the institutional investors think about your stock is on a chart. And so when you see, give me one, Don. Just give me one. I can't pull up a Yahoo. Give me a stock that was a leader, but it's clearly broken down, and the institutions have no use for it anymore.
Triple D printer.
Oh, that's a great one. Okay, let's do that.
That was a while back.
Hold on. Yeah, hold on, Danny.
All the rage.
My charts may or may not. Oh, there we go. They're a little slow to react here. Thinkorswim is a huge resource hog. So let's do DDD. That's a great one. I got to take this to a weekly.
That is a perfect one. 3D printing, the way of the future.
Yep.
Cannabis stocks are another example.
Yeah, and look at this. This is a tremendous move. But right here, this is a weekly chart. And right here, you're like, well, Tim, that's 2014. And there's 2015. Look, this is a weekly chart. You got two closes below the 21 here. And you're like, well, it rallied up and then it rolled over. Even if you use the 10 week, you're like, well, you gave, if you're the person that bought it 50, I mean, I bought it 50, bought it 100 and you sold it 50, you're still better off than having it down to 6.
Yeah, that's the bottom line. It was almost 100 and now it's at 6.
Yep.
Do the
And
math.
so
You can do the math in your head. That's easy.
yeah, and so that's the point we're making here, that no one's going to come out and tell you that, oh, by the way, this stuff is not going to catch on the way we thought it is. It's very specialized, and there's a bunch of Stratus. SSYS is another one. SSYS. Let me wow, 138 to 15. And so it's, and this, look, your portfolio has been littered with this, but ours aren't.
That looks like a giant slide
Yeah.
at the water park.
Yeah, and then look, it's brutal, right? Like you held on, you didn't sell after you got your signaling, and a lot of you don't believe in what we're saying. Like 2 closes below the 21, what does that mean? It means that the people that have sold it don't believe in it anymore. The shift has changed, and if they're dumping it, you know, the market is not one man's trash is another man's treasure. The market is not that. If the people that control the market don't want it, you sure as hell don't want it either. And you're like, well, they're not that smart. It's not about smarts or ego. It's about their money.
Price is truth.
Yeah. And well, that when Danny says price is truth, it's their buying capital that drives price higher and lower. And so it's brutal. It comes down to what, 70 down here, shoots back up to close to 120, and then it's almost like the Titanic, you know, it dips, shoots back higher, and then goes back lower. It gets that vacuum effect, that vortex. And look, this is what we don't suffer through. Like there's very few absolutes in in life. We don't suffer through this because you won't see us argue price. And I haven't mentioned it in a while, but the greatest sale I've ever made is this stock right here. Yeah, it is. And you don't know it at the time.
And it was like a 3% loss, small loss.
So Don and I buy it right in here, March 3rd or 4th. It acts the way it's supposed to act. The market starts to get clunky again, and then it closes poorly, and then we sell it. And then it does.
Later.
Yep, it does this, and it's we were in it at like what 35 or 40, something like that. It was 37, 40. We got back out. It was a small 3% loss, like Danny mentioned, and then it goes on to lose.
That's $1.38.
Almost 100% of it. I mean, it's nothing. You know, and so it's a big deal. You don't know how it's going to turn out, and so it's really important that I just can't say that enough. And did we drill the mutual fund point home, Don? Did we achieve what we wanted to achieve there? Because we've got people that are coming into our world that they're still negative on the year because they've got these mutual funds. Do we want to address what can people do if they're getting mutual funded to death?
Well, the point is, I mean, if you got into them, you get anything that you get into, make sure you know where you're getting out of it. I don't begrudge anybody that bought liquid alternatives investment mutual funds if they would have gone up since 2009 and added the diversification to the portfolio and made them money. But
Yep.
it didn't do any of those things.
So said another way, whenever you buy something, you need to know exactly where you'd sell it at that point. Now you may adjust it as time goes on. As if it goes up in price, you may move up where you would sell it. But and it doesn't have to be necessarily a hard number, but it's got to be either a hard number or a hard stop it's 4%, 6, whatever that is, or 2 closes below the 21 EMA, or something. You've got to know when if you don't have a buy spot, a sell spot when you're buying,
Yeah,
you're playing with professionals and you're an amateur.
so let's do this. I didn't realize how long we've been going on the show here. That's a lot of information for people to take in. And so here's what I want to do. Danny, let's give them in a minute. Let's give them the standard close. Okay. Don, let's do some 21 over 21 work. Let's pull up some stuff on your watch list. I'll give folks my watch list, what I'm looking at. And then we'll take it home. What do you think, boys? You want to do that?
Fine by me. You want me to take us out now? All right,
Yeah,
folks.
hold on a second. You know what we didn't get to this week, and we'll do it next week. We still haven't gotten to the reasonable annual return question, but we'll do that next week.
All right, folks, listen, if you liked what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. They can sign up for our daily, hit the subscribe button. They can sign up for our daily market insight, a short video, about 10 minutes to Tim and Don alternate on, giving you investment ideas, what we're doing in the shop, if we think it's dangerous or there's a green light in the markets. You can also go to the webinars button, and that's Don's monthly webinar. He does one on a Wednesday, noon Eastern, during live market hours. It's about an hour long, Q&A at the end. And even if you can't make it because you're working, he'll send you the link afterward if you just register. And we're not going to spam you to death or reach out to you. It's up to the person consuming our material to reach out to us if they're interested in our services. You can email any of us, Dan@revereasset.com, Tim@revereasset, or Don@revereasset. You can follow me on Twitter at @1 Danny Stewart, at TJ Riazor, or at D Vandenborg. And you can also call us old school at 855 Real Wealth.
Okay, that is that. Don, you ready to talk some stocks?
Yeah, you mentioned we got out of DDM and UWM when the Dow and small caps were at their +3 ATR. Some of that capital things I redeployed into this week. Facebook.
Oh yeah, yep.
After that gap up, I liked the nice gentle pullback, a big move up on volume, and then the lower volume pullback to the top of where it gapped up that day.
Mm-hmm.
So pretty low risk entry there. Added Square, same situation, strong earnings reaction followed by a pullback.
But those charts almost look similar, don't they?
Yeah. The Trade Desk, I sold it before earnings. Same situation of strong move up on earnings, pull back to the mean. And AMD, which is one of the strongest stocks in the market. Several failed breakouts, big move up, and pullback. And PayPal finally.
Oh, I like PayPal. Like the PayPal.
Same situation, strong reaction to earnings, lower volume pullback.
All those charts look absolutely similar. That's uncanny. So you know what? I had a list, but I think this list is better. Excuse me. So let's give you this list one more time. I think these 8 stocks are worthy of being studied more. There's PayPal. Don just told you about PayPal. And Facebook's not, you're like, Tim, where's Facebook? Where's Square? Look, this is one screening tool. It's one screening tool. And so,
full disclosure, we own a few. We own what, 3 of those?
Oh yeah, we own Amazon, we own Dexcom. Don owns PayPal, he owns TTD. I don't own Take-Two, I don't own Vive, I don't own EPAM, but you know what they are? They're on my watch list. So, and look, there's only so much water you can touch. Like if you go swimming, it's not a bad swim. Yeah, water. You know, it's not a bad swim when you go swimming in the lake or the ocean. You're like, oh, I didn't touch all the water, so it wasn't that good of a time. No. You can't be in everything. If you want to be in everything, just buy the indices. And so, you know, what we're trying to help you with is that decision-making process. And then we really didn't talk about it too much today, but then having the courage of your convictions to sell, having that plan to sell and honoring that plan to sell. And Don and I, he mentioned DDM, which is the Dow double. So when you look at the YMs come up, They ring the bell, and it's like, you know what? Even if they flag out here and they want to go higher, that's great. We'll get another opportunity to get in. It doesn't have to be something nefarious that it pulls back to the mean. It could be, or maybe these all come up to meet while this consolidates that really nice gain. But rings the bell, and Don used the words very apropos. Where can we redeploy that capital to keep the velocity of money moving forward and just reapply our rules to those stocks? So hopefully that all makes sense. Danny, last words, go ahead.
We'll talk to you next week on Your Money.